Alright, hey traders, this is going to be a market update for the 22nd of May 2012. So I'm going to give you guys my thoughts on the markets going forward for the next couple of days and also my current positions. So as you guys know, I got a little hit last week in the sell-off we had in the risk-on markets, equity markets. So as you know, I was getting long as we started breaking the 1325 level, and we did close on the lows of the week. I did still have a major position on going into the weekend in both equities and oil as well. This is oil. You can see the major drop we've had, and we haven't really had a recovery in oil. And today, well, yesterday at the close, I basically liquidated 75% of my positions for a loss, small loss, not a too devastating loss. I was expecting this bounce. However, the damage we saw from the breakdown in the last few weeks was too great to expect a bounce higher to the 1350 level, where my average position was around the 1335 area in the S&P 1330 area. And then I had bear positions in oil and also a bit in gold, which I did see some profits in. So basically, I took out 75% of my positions yesterday, and let's drill into today. I also took out a bit of the rest of my positions long and actually moved short earlier in the day below the 1320 area in the S&P. Then as we broke higher, I actually got short more in the 1325 level. So now I am basically short from the 1321 half area in the S&P. I'm also short some oil in the 92.65 level. I'm basically having a short leash on oil for the fact that, still technically we may see a bounce quite soon. You can see the bond market has really sold off today into some support levels. So I believe we could see a further bounce higher. If you look at my blog post from yesterday, you can see kind of my reasoning behind my bearishness given Europe. I do think that the problems that the Eurozone is having, obviously Greece in particular, will have a bearish impact on equity markets in the next couple of weeks. Greece has failed to sustain a stable government in the last few months, obviously with the failure of the Greek elections a few weeks back, well, a week back or so. So I think there's going to be a lot of uncertainty. I also believe that there is a bit of a bailout premium priced into the markets right now, especially with yesterday's rally. I think that people are actually expecting a bailout in Greece, and so I think the better reward to risk trade is to be shorting risk on markets and potentially and also shorting pig bonds because basically I think this bailout premium is offering a better, once again, reward to risk opportunity. So basically, if we're shorting risk on assets here, we're looking for further uncertainty in regards to a Greek bailout. Are we going to have one? Is Greece going to exit the Eurozone? That's really the big question on everyone's mind right now. And I personally think that although the short-term effects of a Greece exit will be detrimental to the markets, I think in the longer term it will be a much better idea, as you're basically well, number one, Greece will undertake a new currency, and that will help Greece in the long run with a lower currency relative to the euro. There will be more investment in Greece if their currency is lower. And basically they don't have to be tied into Europe in every decision they make. Also, Germany will have a less of a burden to worry about, as Germany, as we know, has been basically supporting most of the Eurozone for the past couple of years right now, with its nice growth and being an economic powerhouse, the biggest economy in the Eurozone. So I think in the longer term it's going to be better. Obviously, the contagion effects are going to be potentially substantial. We obviously don't know the how bad it could get. But once we overcome that from a Greece exit, I think once again in the longer run, it's going to be better for Europe. So in the meantime, I think the process of either Greece exiting Europe or the wait for a Greek bailout, if that does occur again, will create more uncertainty in the markets and create a further sell-off below the 1300 area on the S&P. Again, very rarely, and I always touch on this whenever we're in a bear market. Well, obviously we're not necessarily in a bear market right now, but we're in a correction, potentially leading into a reversal into a bear market. What I always like to touch on is how markets bottom, and typically, once again, typically we very rarely see a V bottom where, and this is just from the technical picture, we very rarely see a V bottom where we just, we puncture a major area and rally straight to, important levels. For example, last year, in August, when we had this major sell-off, we saw the break below 1100. Even though we had a nice rally back to the 1225 level, there was always that magnet, which was the 1100 level on the S&P, because we only tested it for one day. We only spiked there, and we never really got to do trade around that level. So very rarely do you see a V bottom where it's a 1 to 2 day bottom and the market doesn't retest it, and we did see that retest again. On the second retest, it's very likely that we can see a complete reversal, just like in last year. We had the major spike in 2010. We had the major spike on the flash crash. We recovered all the way back to 1175, but that magnet where hardly any trade occurred, but trade did occur there, attracted the market down to those levels, and once again we saw it back in July. Although that was a multi-day bottom, that's a different type of bottom. So anyway, these 1 to 2 day bottoms are very rarely hold, and so I believe that we are going to see a reversal back down into the 1300 level to probe those areas to see if we could do any more trade there. We also do have some resistance overhead at the 1325. This is when the sell-off really accelerated. If we take a look at the 60-minute chart, you can see this is where we really started to break down. So now that the market is retesting that area, we're seeing if these sellers are going to hold strong. Also, we're having some structural divergences between commodities and the S&P. For example, you can see how oil has hardly even rallied. That's showing some extreme weakness. The fact that oil is selling off so relentlessly is showing a global slowdown. We're also starting to see agriculture turn around, although that's not necessarily a most important factor. And we also have Facebook, that IPO'd on Friday, and so far it's been a failure with a PE ratio of 72. That's, in my opinion, just insane. And the valuation that it had on Friday of above 100 billion. I was expecting Facebook to fall. Obviously, the only way to profit on it is if you do kind of a proxy trade, which I did do in LinkedIn. I did purchase some puts, which I've almost liquidated all my positions. Or if you did Zynga, which also had a sell-off on the Facebook IPO. But that's not a good sign to the market that Facebook couldn't even hold up on the second trading day, how we just broke right through and dropped almost 25%, or has it been 25%, or around that area. So it's been a major sell-off in Facebook. That's not really good for the psychology of the retail investor. And so I think all these things together, also the euro, you can see, has failed to really have a balance. We are starting to reverse today again lower. So I think these are all factors that should drive equity prices lower as well, which is where I have the majority of my shorts on. So basically, the premium that the equity market is offering is more attractive to me than shorting, for example, oil or the euro. And so that's basically my game plan. I'm looking for the S&P to continue lower to below the 1300 level again.